6. What is fiat good for? An economist who has seen the havoc and destruction fiat money has wrought upon the world might be tempted to focus purely on the fiat system's many drawbacks and predictable problems. But in writing this book, I chose instead to think long about the technological advantages that fiat entails. I admit to having acquired an appreciation for the technological improvement the use of fiat money allowed. Rather than a nefarious conspiracy to impoverish the majority to benefit the few, there was an undeniable economic and technological rationale for fiat money, given the technological possibilities of the world at the early 20th century. The analytical lens of the Bitcoin standard was salability across time, which can be understood as the degree to which a money holds its value over time. Based on Antal Feket's work, I argued that the stock-to-flow ratio provides us with a good proxy for intertemporal salability, as it indicates how much supply can be increased to match increasing demand. Historical examples of primitive monies and national currencies demonstrate how monetary goods with higher stock-to-flow ratios displace monetary goods with lower stock-to-flow ratios. Yet the framework of intertemporal salability alone is insufficient to explain why the world moved from the gold standard to government monies with significantly lower stock-to-flow ratios. This book uses the analytical lens of interspatial salability to explain the technological and economic driving forces behind this change. Fiat's superior salability across space gave it the economic and technological impetus to blanket the planet in the 20th century. There are two other use cases for fiat that have increased its adoption: unparalleled ability to finance government spending, which was discussed extensively in Chapter 4 of this book and in Chapters 6 and 7 of the Bitcoin Standard, and the protection of banks engaging in fractional reserve banking, maturity mismatch, and rehypothecation, discussed below. Understanding how this technology is naturally very conducive to the goals of governments and banks can go a long way toward explaining its mass adoption in the 20th century. Salability across space. Money is the economic solution to the problem of coincidence of wants, and examining this problem allows us to determine the desirable characteristics of potential solutions. If Alice wanted to buy something from Bob, but Bob did not want what Alice had to offer, the only solution for them would be to engage in indirect exchange. Alice exchanges her good for one that Bob desires, and then exchanges that good with Bob. Alice purchased the intermediary good purely for the purpose of exchanging it for another good, not for its own desirability. As the variety of goods an economy produces grows, indirect exchange is the inevitable solution for facilitating exchange. That some goods will play this role better than others over time is inevitable. The more a good is suitable for performing the function of a medium of exchange, the more saleable it is. Carl Menger defines salability as the degree to which a good can be brought to market without a significant loss in market price. A highly saleable good is one with significant market depth and liquidity, making it possible for the holder to obtain the prevailing market price whenever they want to sell it. A good example for a highly saleable good today might be the $100 bill, accepted worldwide by merchants and currency exchange shops more than any other monetary medium. A holder of a $100 bill looking to exchange it for goods and services will rarely ever need to sell it for something else to provide to the seller, nor will they ever need to sell it at a discount. They will usually quickly find someone to take it at face value. By contrast, a good with low salability is one for which demand on the market is intermittent and varied, making it difficult to sell the good quickly, and requiring its owner to offer a discount on it in order to be able to sell it. A good example of this is a house, car, or other forms of durable consumer goods. Selling a house is much harder than selling a $100 bill, involving viewings and significant transaction costs, as well as waiting for the right buyer who values the house at the seller's asking price. The seller might need to offer a significant discount to sell the house quickly. In capital markets, the most saleable instruments are U.S. Treasury bonds, which at the time of writing are collectively worth around $28 trillion. Most large and institutional investors use U.S. government bonds as their store of value and Treasury reserve asset because it is easy to liquidate large quantities without causing large movements in the market. Central to Menger's analysis of salability is the measure of the spread between the bid and ask prices for assets, where the bid is the maximum price that a buyer is willing to pay, while the ask is the minimum price that a seller is willing to take. Bringing large quantities of a good to market would cause the spread between the bid and ask to widen, as potential buyers begin to offer lower prices as the marginal utility of the good declines with increased quantities. The more a good's marginal utility declines with rising quantities, the less suited it is to the role of money. The smaller the decline in a good's marginal utility, the less the bid-ask spread will widen as larger quantities are brought to the market, the more saleable the good is, and the more suitable it is for use as money. We can also understand this process from the perspective of traders buying goods to sell them on later. For them, growing stockpiles of a good reduce the chance of each marginal good being sold, and the risk of price changes negatively affecting the seller increases. Thus, they will bid at lower levels for increasing quantities of a good. The faster the spread between the bid and ask grows, the less saleable the good. Goods for which the spread rises slowly are more saleable goods, and these goods are more likely to be hoarded by anyone looking to transfer wealth across space or time. We can think of salability as existing across three axes: time, space, and scale. Salability across time measures the ability of a good to maintain its market value into the future. As discussed in the Bitcoin Standard, the emergence of gold as the world's money was no coincidence but was instead the result of gold having the highest stock-to-flow ratio of all metals. That means gold's supply is the least elastic in response to demand and price shocks. When more market actors turn to gold as a store of value, gold miners have no way to quickly increase the existing stockpiles on the market. This is because annual mining production is always a tiny fraction of global stockpiles, regardless of what new technologies miners deploy in pursuit of more gold. Gold stockpiles have been accumulating over many thousands of years, thanks to gold's physical incorruptibility. Global stockpiles of other metals amount to little more than a few years' production because of their constant degradation. Should monetary demand cause the price of these metals to rise, miners can increase production, thereby significantly increasing existing stockpiles. Gold is the only ancient metal with this property of incorruptibility, and all the other indestructible rare metals, including platinum, palladium, and titanium, have only been discovered in the last few centuries. That means humans have accumulated much smaller stockpiles of these metals in comparison to gold. This discrepancy in historical stockpiles means non-gold metals have a much lower stock-to-flow ratio. Silver, the precious metal with the second highest stock-to-flow ratio, maintained a historical monetary role, particularly for smaller value transactions for which gold was unsuited, thus addressing gold's limited salability across scales. Salability across space can be measured as the reduction in the market price incurred by the seller due to the distance between them and the buyer. An immobile house is not saleable across space at all, as moving a building would destroy it. Any bulky good will have low space salability because of the heavy cost of transporting it, resulting in a loss of revenue for the seller. Spatial salability helps us understand the success of monetary metals and gold's monetary superiority to other metals. Metals have a relatively higher value per unit of weight and volume than cattle or agricultural commodities. Large amounts of value could be minted into relatively small weights of uniform metal to standardize coinage and make these coins recognizable to more people across wider geographies. People using uniform, easy-to-transport coins knew that the coin's purity was relatively easy to verify, allowing for wider geographic dissemination and superior salability across space. The Roman Empire's aureus became the first world money because of its recognizable imprint and standard purity and weight. Gold's high value per weight made moving value with it cheaper than using silver. In the 19th century, gold was 15 times more expensive than silver, thus making silver more expensive to store and transport. Today that ratio is around 70-1 in favor of gold. Making a payment with gold would thus require transporting a far lighter load than silver, copper, or iron, meaning it would incur a lower cost. Gold's chemical stability and indestructible nature meant that moving it around was relatively safe. More value concentrated in less weight obviously resulted in a currency that was cheaper to transport. As a result, a buyer would expect to lose less value when moving currency long distances for transactions. This spatial salability was key to gold's superiority over other precious metals. But a gold coin's salability nonetheless declines with distance, as the cost of transporting it rises. Physicality means distance will always result in reduced salability across space. In the late 19th century, the steamship, automobile, and railroad spread worldwide, and they were soon followed by the airplane. As transportation costs declined significantly, the possibilities for mutually beneficial trade expanded everywhere. For the vast majority of the world, this meant greater integration and more varied trading with global markets. While gold's salability across space was still the best of all metals, it was still not fast enough to allow for cash settlement of individual trade transactions across cities and national borders. Naturally, banks would work around this problem by resorting to a system of clearance and settlement among one another to save their clients the transaction costs involved in transporting physical gold for every transaction. When Alice would make a payment from her account at Bank A to Bob at Bank B, the two banks would not attempt to move the equivalent sum of gold. Instead, Bank A would debit the sum from Alice's account on a written ledger and send the clearance to Bank B, confirming that Alice has the money to make the payment. Bank B would then credit the sum to Bob's account. Hundreds or thousands of similar transactions can happen between banks before one final clearance. As capitalist division of labor and international trade expanded, the cost savings of bank gold settlement became more compelling. Banking became a more centralized business because more centralization brought great cost savings. National central banks emerged to settle trade with foreign countries, allowing periodic and regular international settlement between central banks to reduce the cost of transfer, as opposed to the prohibitively expensive international movement of physical gold. In order to move gold as fast as modern transportation was moving goods, it was increasingly stored in vaults, and financial institutions and individuals traded claims upon that bank-held gold. Over time, market participants moved away from the finality of taking physical custody of gold following a payment, and money increasingly became a liability of financial institutions, which allowed it to move when needed. The more efficient the system, the less gold movement it required, meaning hugely decreased transportation costs. However, the savings achieved through centralization came at the cost of a less secure, and less auditable, financial system. Although banks could honor their promises to redeem any of their obligations for gold, they could issue more gold liabilities than the gold they had on hand, thanks to its limited spatial salability. Several factors contributed to this early fractional reserve system. For one, there was no easy and convenient place for bank clients to redeem their gold and still use it for settling the increasingly global trades they conducted. With only one monopoly bank in a town, or one central bank in a country, your gold coin had very little spatial salability while it was in your physical possession. In other words, if Bob or Alice wanted to engage in international trade, they could only do so by trusting a centralized bank. The gold standard's monetary medium was not just the gold underlying it, but also the payment and settlement rails that allowed it sufficient spatial salability to move around the world. Gold in the bank effectively carried a spatial salability premium over gold in individual physical possession. Rather than charge individuals a premium for holding their gold with high salability, banks kept gold redeemable at face value, but increased the amount of liabilities they issued backed by it. This arrangement was unstable and self-defeating. The more money that flowed into banks, the higher the premium for having gold in banks, the more gold in the banks, the more banks could inflate their liabilities. This dynamic would fuel the bubbles and business cycles that resulted in liquidity shortages and financial crises. Gold's limited salability across space allowed it to be replaced by government fiat money. The Bank of England had little trouble coaxing gold out of the hands of the British people because without the bank's infrastructure and settlement rails, physical gold coins had very low salability and could not offer their holders final settlement across long distances. In order to achieve greater utility while engaging in international trade, people had to sacrifice the security that came with the physical custody of gold. Although gold is highly salable across time, its salability across space is very low compared to fiat. This is as significant a flaw as having a low stock-to-flow ratio. Whereas a low stock-to-flow ratio leads to a loss in value when trading the good across time, a high cost of transportation results in a significant loss of value when transacting the good across space. Hard money advocates can deride fiat money for losing its value across time, but they dismiss the reality that an ounce of gold sent across the world will arrive having lost a significant portion of its value to pay for its movement. In a sane world, a world in which monetary systems were designed by engineers, gold's salability across time would lead to it developing the best salability across space through banking infrastructure. But in the real world of centralized governments, expecting political money to deliver hard money with high interspatial salability is wishful thinking. A hard money that requires brick and mortar banks in order to clear it is always liable to government seizure or being replaced with government fiat. Political and engineering realities mean that the low spatial salability of gold and physical monies needs to be considered a feature, not a bug. Spatial salability also helps us understand why the US dollar continues to garner increasing international demand while other national currencies struggle to maintain their comparative values. The dollar has by far the highest spatial salability of all national currencies, as it is the prime currency for international settlement, and there is a market in US dollars and US government bonds everywhere in the world. Other national currencies are rarely accepted outside their national borders, and non-dollar paper notes will usually be heavily discounted if sold there. Gold spatial salability. The Bitcoin Standard quantified salability across time by using the stock-to-flow ratio. For salability across space, the best metric I can think of is the cost associated with clearing and settling the monetary equivalent of a London Bullion Market Association, LBMA, Good Delivery Gold Bar across the Atlantic. Choosing the LBMA Good Delivery Gold Bar for this analysis makes sense because it was traditionally the standard unit of settlement for international trade between financial institutions under the gold standard. Further, central banks, financial institutions, and individuals still use LBMA bullion, or similarly sized bars, for gold settlement today. LBMA bars are the gold standard of gold bars. A good delivery bar weighs around 400 troy ounces, or 12.5 kilograms, and has a market value of around $750,000 in 2021. If the world ran on a gold standard, international financial settlement would likely happen in this unit. That it does not run on a gold standard is a function of how expensive moving this bar really is. One can point to government restrictions on the free movement of gold as the reason for fiat's rise, but that misses the point. If gold had high salability across space, it would not need governments to ensure its monetary role. We can get an idea of the costs involved in settling gold across the Atlantic at the genesis of fiat by examining the historical transfer of gold from the Bank of England to the US and Canada, a process we discussed in Chapter 2. During the First World War, Britain shipped 94.4 million pounds of gold to the US and 226 million pounds of gold to Canada, most of which was later transferred to the US. Total British gold exports amounted to 259.3 million pounds, or around 70 million ounces of gold, which today is worth around $130 billion. In 1919, when the war ended and the Bank of England wanted to repatriate some of its gold from Canada, Osborne reports it hired the Dominion Express Company from St. John's, Canada to transport it to Liverpool, England, at a cost of $2 per $1,000 of gold carried. We can therefore estimate that in the final days of the gold standard, it cost 0.2% of value transacted to ship gold across the Atlantic. But the process was often more complicated. One of the many gold shipments from Great Britain to the US in 1917 had 3,211 gold bars, weighing around 40 tons, or 1,285,000 ounces, rode aboard the SS Laurentic from Birkenhead, near Liverpool, to Quebec City in Canada. The gold the Bank of England loaded onto the Laurentic was worth around £5 million at the time, but it would be worth around $2.4 billion in current fiat terms. The Laurentic and its enormous treasure disappeared to the bottom of the ocean after it struck German mines off the northern coast of Ireland. The Admiralty ordered Captain Guy Bondaman to lead a team of divers to salvage the gold. After 7 years of diving, Damon's team were able to salvage 3,186 of the 3,211 bars, with only 25 left unaccounted for. 3 more bars were to be recovered in the 1930s, but 22 bars remain unaccounted for more than a century after their sinking. The total cost of Damon's salvage operation came to £128,000, around 2% to 3% of the total value of the gold on board. The salvage operation remains the largest recovery of sunken gold by weight in history. A century later, Germany decided to repatriate its gold reserves from New York and Paris. This transaction was for around 54,000 gold bars weighing 12.5 kg each, worth around $27 billion at the time. It took 4 years to complete, 2013 to 2017, and cost $9.1 million, including auditing and authenticating the bars. The transaction cost was around 0.03% of the total value. As the cost for shipments from Paris and New York, this estimate is likely lower than the price for the cross-Atlantic trip from New York, which we could estimate as being somewhere around 0.05 to 0.1% of the value of the gold. The cost of shipping an individual gold bar across the Atlantic is around $3,000, based on a quote I received from a Swiss gold dealer in Zurich. As the price of a good delivery gold bar is currently around $750,000, the bar would lose around 0.5% of its economic value when shipped across the Atlantic. The transfer would require 2 to 3 days to complete. These 3 data points over a century give us a rough range of the cost of shipping significant amounts of gold across the Atlantic, ranging from 0.01% to 0.5% of the value of the gold. Beyond the cost, moving physical gold carries a serious risk of loss and requires the use of critical reliable physical infrastructure, like airports, seaports, and trains, which governments control. The inability to transport gold across international borders in any significant quantity without the approval of government authorities rendered it increasingly expensive for long-distance economic transactions, especially when compared to the bank settlement networks, as only central banks could settle trades across long distances and international borders, something gold could not accomplish. These financial institutions' fiat and political decrees came to play the role of money. Governments and their central banks gained unprecedented power to shape society as a direct consequence of the centralized system of international gold transportation. Fiat spatial salability. Fiat transactions do not necessitate a lot of physical shipments because they are largely made up of credit obligations, i.e., immaterial entries on balance sheets. The small fraction of fiat money that is physically printed moves around, but this is an increasingly insignificant part of the total money supply. In most cases, settling fiat money involves debiting and crediting ledger entries in different places. When an individual wants to make an international wire transfer over the fiat network, the sender's bank account issues a payment order to the SWIFT network, a cooperative society based in Belgium and owned by its member financial institutions around the world. SWIFT is a messaging platform, not a platform for transferring funds. It sends payment messages to recipient banks, but it does not send actual money. The fee to wire funds across the Atlantic is usually in the range of $10–50, and it takes around 2 to 5 working days for the recipient to receive the payment. But the settlement of funds from the two banks can take significantly longer to finalize, as finality depends on the various banking relationships involved. Should the two banks have a correspondence bank account with one another, they can batch and settle all their transactions at the end of the day, week, or month. But should they need to resort to intermediaries, then the transaction is settled sequentially between intermediaries according to their periodic schedule of settlement. The sending bank credits the account of its correspondent bank, and once the latter receives the money, it credits the account of the recipient bank, or the next intermediary in line. These intermediary correspondent banks will also charge some fees for currency conversion. More fees means increased costs for the wire transfer, costs that will be absorbed by both the sender and recipient. Despite the individual user seeing a cash credit on their balance sheet after just a few days, the final settlement of the transaction will occur several days, weeks, or months after the transfer has been initiated. Fiat payments over credit cards will involve even more intermediaries, and while the initial payments will be cleared in a matter of seconds, at a fee of around 1% to 3% of the transaction's face value, the final settlement may take months to complete. Distinguishing between the costs of making a payment and those of making the final settlement is important when examining the fiat system. Gold banking no longer exists in any meaningful sense, as there are no banks holding accounts in gold and allowing international payments to be made with gold, which makes comparing gold and fiat not a like-for-like comparison. Unlike gold shipments, fiat consumer payments are not final settlement transactions. Final settlement in fiat does not necessarily offer much improvement in speed over shipping physical gold, but it is significantly cheaper, as it involves little more than the transfer of electronic data. As gold standard payments increasingly became credit payments and not cash settlement, the payment rails of banks and central banks became an increasingly important part of the monetary infrastructure that made payments possible. That the operators of the rails would favor a diminished role for physical gold seems obvious and inevitable in hindsight. Without the cheap and fast gold settlement outside the banking system, there was little to deter them from this step. The Faustian bargain of fiat money appears inevitable this way. The technology of fiat strongly benefits governments and banks, as will be discussed below, but it was the spatial salability of fiat that allowed them to take advantage of it to their own ends. Spatial salability is the key to understanding the fiat monetary system's evolution and survival and the most important criterion by which to assess Bitcoin's competitive threat to government central banks. Bitcoin's ability to settle hundreds of thousands of transactions worldwide regardless of the distances involved gives it a far superior spatial salability to gold, and its ability to cross borders and perform final settlement in a matter of hours is not contingent on the fiat of political authority. Bank profitability. The Fiat Standard's second killer app is enabling fractional reserve banking, the dubious practice of holding deposits on demand without having their corresponding value available in cash on hand. Under a fiat monetary system, banks issue loans and create deposits for clients many times their cash reserves. This system is spectacularly profitable for banks since it allows them to keep their money in one place while lending in another location, the fiat version of a double spend. A bank can operate on fractional reserves perfectly fine unless and until a critical mass of its customers all come calling for their holdings. But even in such an event, the bank knows it will have the safety net of the central government and central bank as lenders of last resort. Should the fractional reserve house of cards begin to collapse, as it inevitably will, the banks know that the government will simply conjure credit out of thin air to bail them out. Under the gold standard, by contrast, banks were kept on a relatively tighter leash in terms of their ability to generate financial obligations. Bank clients could at any time ask for the redemption of their bank notes and checking accounts in physical gold, and if the bank was short of gold, there was no authority that could print gold on demand to meet the bank's obligations. The U.S. Congress passed, and President Woodrow Wilson signed, the Federal Reserve Act into law in 1913 in response to the financial crisis of 1907. In which overextended fractional reserve banks faced a liquidity crisis. During that crisis, J.P. Morgan, Wall Street's leading banker, relieved that liquidity crisis by acting as the lender of last resort for banks facing insolvency. The episode motivated banks to seek the establishment of the Federal Reserve Bank to alleviate future liquidity crises. Proponents of this legislation provided two reasons for the federal bank to create central banks. 1. To protect the banking system from bank runs or financial crises, and 2. To stabilize the value of the U.S. dollar. That these two goals were directly contradictory is the kind of blatantly obvious fact only noticed by economists like Friedrich Hayek.
I would emphasize that bank deposits could never have assumed their present predominant role among the different media of circulation, that the balances held on current account by banks could never have grown to 10 times and more of their cash reserves, unless some organ, be it a privileged central bank or be it a number of or all the banks, had been put in a position to create in case of need a sufficient number of additional bank notes to satisfy any desire on the part of the public to convert a considerable part of their balances into hand-to-hand money. The fundamental dilemma of all central banking policy has hardly ever been really faced. The only effective means by which a central bank can control an expansion of the generally used media of circulation is by making it clear in advance that it will not provide the cash, in the narrower sense, which will be required in consequence of such expansion, but at the same time it is recognized as the paramount duty of a central bank to provide the cash once the expansion of bank deposits has actually occurred and the public begins to demand that they should be converted into notes or gold.
Inevitably, the goal of protecting the value of the cash conflicted with the goal of protecting banks from bank runs, and central banks have almost always favored the financial system at the expense of the currency's value. The Fiat Standard, and the moral hazard of having a lender of last resort, has served as a giant boon for the global banking industry. The Federal Reserve Act effectively gave banks a license to create money out of thin air and a safety net to protect them from its consequences. Is fractional reserve banking necessary for a growing economy? The argument for the necessity of fractional reserve banking ultimately boils down to the same arguments that Keynesians, inflation apologists, and monetary cranks of all hues use for monetary expansionism in general. An increase in the supply of money will lead to more economic production. By this logic, banks that can create loans in excess of the capital they hold in reserve can mobilize more capital and finance more projects, resulting in less unemployment and increased prosperity. Conversely, if banks are prevented from engaging in fractional reserve banking, a shortage of credit would hamper economic activity, reduce production, and reduce living standards. By using fractional reserve banking to decouple available credit from savings, society benefits overall. At least, that is what Keynesians believe. The problem with this logic is the same as with all inflationist arguments: money and credit, by themselves, are not productive assets. They merely represent receipts that allow their holders to purchase productive assets. An increase in the supply of money or credit will no more increase the stock of productive assets in an economy than an increase in printed football stadium tickets will increase the capacity of the stadium itself. The ticket is merely a proxy for a seat in the stadium, and money and credit are but claims on final products and the capital goods used in their production. Should a football team wish to increase the maximum number of tickets it sells, it cannot do so by simply increasing the number of tickets it prints. Instead, it would have to increase the stadium's capacity, which requires engineers, workers, and heavy capital equipment to complete. Printing tickets beyond the capacity of the stadium would result in more spectators than seats and a conflict over these seats, but it cannot, under any circumstance imaginable, cause an increase in the number of seats. There can be no such thing as a shortage of money or a shortage of credit. Whatever supply of money an economy is using is always sufficient to supply all the needs of the economy, provided the money itself is divisible enough. The demand for money is always higher than the supply, because people desire more things than they produce and because desiring is far easier than producing. In the Fiat Standard, it appears that these desires can be satisfied with more money, but the creation of money to meet these desires does nothing to produce the objects of desire. The sought-after good can only be created by dedicating scarce resources to its production. In a hard money-free market, people dedicate their time to production in order to make money, and as the quantity of goods and the amount of economic production increases, the supply of money need not increase, but its value will naturally rise. Fractional reserve banking does not magically create more capital, labor, or resources. It merely allows central banks to control the allocation of these resources rather than the productive people who own them. Fractional reserve banking is a form of central planning that impoverishes society overall but enriches banks and politically connected individuals. Without fractional reserve banking and the fiat that protects it, capital and labor would flow to the highest bidder, and that will always tend to be the entrepreneur who uses capital and labor most productively. This would encourage people to save, as free market forces work to efficiently allocate resources according to the most productive and valuable endeavors. With the bank credit creation of the fiat system, capital allocation becomes increasingly political and centrally planned, and failed users of capital can still continue to control it if they are allowed to create credit. The market's natural process of creative destruction and reallocation of resources is thwarted the more that credit is politically manifested rather than generated from savers. Can fractional reserve banking survive in a free market? Fractional reserve banking is not necessary for an economy to function, but such systems nonetheless remain prevalent the world over. How can we explain this apparent contradiction? In particular, how can we explain that economies that have used it seem to prosper, and that the majority of banks employing it do not fail? To answer these questions, we must examine the role central banks play as the lenders of last resort for banks operating with fractional reserves. In a free market, a bank that engages in fractional reserve lending will find its assets and liabilities mismatched. For instance, it may owe a depositor $100, available to them on demand, but will simultaneously loan out a fraction of that money to a borrower. Should the depositor request all their money when the borrower still has it, the bank has a problem. But since the bank has more than one borrower and depositor, returning money back to the depositor by giving him another depositor's cash keeps the system afloat. As the amount of lending increases, along with the fraction of deposits lent out, the bank's position becomes increasingly precarious and vulnerable to a bank run. To make matters worse, once depositors and borrowers discover the increasing amount of unbacked credit issued by the bank, they become more concerned about the safety of their deposits and thus more likely to demand their withdrawal. If the amount of cash depositors demand exceeds the bank's reserves on hand, the bank has a liquidity problem. This is viewed as distinct from a solvency problem, because the bank does have enough assets to meet all its depositors' withdrawal demands, but it does not have them on hand. There are a few different ways to address liquidity problems. For one, banks can simply satisfy withdrawal requests on a first-come first-served basis until they run out of cash. Another way is for the bank to redistribute the problem to all customers by taking a percentage haircut off each depositor's balance until the bank's total reserves match the total of all depositors' newly adjusted balances. In effect, this method transitions the bank to full reserve banking, which then allows all depositors to withdraw their total, and newly reduced, balance simultaneously. Both options imply the bank's bankruptcy, as its assets cannot meet its liabilities to depositors and lenders. While these options can be devastating for both the bank and its depositors, they are in fact the healthiest way to deal with this problem. At a bare minimum, both depositors and bankers learn not to engage in such activities again. And if they don't, they are left with less capital and reputation with which to attempt it. The alternative option introduced over the last century is the creation of a government-mandated central bank to inject liquidity into the struggling bank and allow it to meet its obligations to depositors. Now, with a monopoly on the issuance of money, the central bank can effectively monetize the obligations of the bank and offload the risk of the bank's reckless actions onto all the holders of the nation's currency, not just the bank's depositors. Full reserve banks then become unprofitable in comparison, as they bear the burden of responsible risk management, limiting their upside relative to their fractional reserve counterparts. The emergence of modern central banking cannot be understood separately from the problems caused by fractional reserve banking. As Guido Hulsmann put it,
fractional reserve banking is not unrelated to central banking, fiat paper money, and international monetary institutions such as the International Monetary Fund. Ultimately, these institutions are abortive attempts to solve the problems of fractional reserve banking by centralizing cash reserves or by refusing redemption of money titles.
Shadow fractional reserve banking. Fractional reserve banking, in the institutional manner discussed in the old works of Mises and the Austrian economists, is no longer the serious problem it once was. As mentioned above, the tension between banking solvency and currency hardness was resolved in favor of the former. With time, the Federal Deposit Insurance Corporation, FDIC, and its international equivalents, came to play the official role of lender of last resort. Laws like Glass-Steagall segregated banking from investment banking and endowed only the former with the protections of a lender of last resort. Supposedly strict lending criteria were implemented to prevent too much credit expansion, and the central bank became the primary determinant in setting interest rates. As discussed previously, this highly complex edifice of central planning did not work too well, currencies continuously lost value, and business cycles were a constantly recurring phenomenon. For many years, however, major economies' haphazard attempts at reining in fractional reserve banking have succeeded in averting major crises by putting some limit on credit expansion. But this arrangement is less stable than it appears, for its illusion of stability contains the seeds of its collapse. That banks would not abuse the exorbitant privilege of government protection from failure is unthinkable. Of course, they would press the limits in search of profits, knowing all the while that a government-backed lender of last resort was ready to bail them out. Those who fail to see this dynamic misunderstand human nature and how humans respond to basic incentives. In the era of modern banking, banks have abused the exorbitant privilege of government protection in several ways. To understand how this has happened, we must examine a relatively new and not well-known phenomenon, the shadow banking system. The shadow banking system is the dirty little secret that the banking sector has used to work around financial regulations. The sector may have ring-fenced retail banking into a highly regulated industry to prevent bank runs, but they have branched out into other models of banking and finance. The shadow banking system comprises financial firms created to take financial risks with fewer regulations and restrictions, and without a formal lender of last resort like the FDIC. They include investment banks, mortgage companies, money market funds, repurchase agreement markets, asset-backed commercial paper, securitization vehicles, and more arcane financial tools. Nonetheless, time has shown that when push comes to shove, the Federal Reserve will act as a lender of last resort to the shadow financial system, in many different ways. First, these financial institutions can secure funding at a lower interest rate than other businesses. The availability of lower interest rates is what led financial companies to acquire larger and larger sectors of the economy. These low interest rates are the reason even non-financial companies have adopted elements of the shadow banking system into their business models. By permitting the institutions that comprise the shadow banking system to access lower rates than outsiders, central governments implicitly subsidize their operations. This implicit subsidy is itself a taxpayer-funded handout because access to lower interest rates allows these institutions to profit relatively easily from interest rate arbitrage. Second, the U.S. central government and the Federal Reserve have repeatedly illustrated that massive financial corporations can engage in wild risk-taking while avoiding any downside. Politicians and Federal Reserve officials have given life to the too-big-to-fail idea by repeatedly bailing out financial institutions that engaged in risky behavior. The bailout rationale is always the same: we're so big, so intertwined in the global economy, so systemically interconnected into every facet of financial life, that not forcing taxpayers to pay for our mistakes will result in economic calamity and pain for not just us, but also for all the responsible people who did not take risks, and who never stood to gain a penny from our recklessness. As far back as 2004, Gary H. Stern and Ron J. Feldman warned of the pervasiveness of a bailout mentality in the financial system in too big to fail, arguing that not enough has been done to reduce creditors' expectations of too big to fail protection. Stern and Feldman outlined several episodes that had, over 2 decades, fostered creditors' bailout expectations. The first episode occurred following the failure of Continental Illinois National Bank and Trust Company in 1984, which at the time was the largest bank failure in U.S. history. The Federal Reserve bailed out Continental Illinois creditors. Shortly after, C.T. Conover, the comptroller of the currency, testified to Congress that policymakers would also protect creditors of the 11 largest banks in the country, since they were too systemically connected to fail. The message to banks was clear: incentivizing them to become too big and too interconnected to fail by taking excessive risks. Several other banks and savings and loans associations failed in the subsequent years, and federal protection seemed to become more generous toward creditors and depositors with time, going beyond its legal requirements under the pretext of guarding against systemic effects. Stern and Feldman argued that the Federal Deposit Insurance Corporation Improvement Act of 1991, FDICA, was insufficient to counter the growing bailout expectations. Further, increased bailouts for debtor countries, as well as the government-induced rescue of long-term capital management, LTCM, in 1998, all contributed to heightened expectations of creditor protection. In time, their warnings have proved prescient. Third, yet perhaps even more important than the first 2 factors, was the growing deployment of monetary policy as a means of rescuing failed institutions and forestalling creative destruction. Under what came to be known as Greenspan's put, former Federal Reserve Board Chair Alan Greenspan repeatedly lowered the official federal funds rate in response to asset price decreases and large firm solvency problems. This politically motivated manipulation of monetary policy allowed large corporations to borrow on favorable terms to save themselves. The Federal Reserve cut the federal funds rate following the 1987 stock market crash, Russia's debt default, the collapse of LTCM, and the bursting of the dot-com bubble. Over and over again, the government used politically expedient cash bailouts and monetary manipulation to protect well-connected insiders from the consequences of their rash and irresponsible behavior. Investors and creditors had found a way of privatizing their gains while socializing their losses. Straightforward solvency problems, market losses, were now treated as liquidity problems, which a lender of last resort could alleviate. Fourth, financial corporations have gone beyond merely exploiting existing laws, they have actively wielded tremendous political influence to bring about favorable regulatory environments. In 1990, individuals and groups associated with the financial sector contributed more than $71 million to the campaign coffers of U.S. federal office holders, according to Federal Election Commission records analyzed by Open Secrets.com. By the 2020 election cycle, that number had swelled to nearly $2 billion. All told, financial firms and their proxies have given American politicians of all stripes more than $8 billion in the last 4 decades. The financial sector's rent-seeking behavior achieved many successes for the industry, one of the biggest wins being the wholesale repeal of the Glass-Steagall Act. With Glass-Steagall stricken from the U.S. legal code, retail banks could once again enter into investment banking. Rather than being the main culprit of this episode, the repeal of Glass-Steagall was more of a symbolic confirmation of the reality that had crept in over decades of government-controlled banking. A giant shadow banking system was now responsible for creating far more of the U.S. dollar money supply than the government or the formally regulated retail banking system. The shadow banking system's ability to increase the supply of credit is hard to measure or understand, as its many organs move in many different ways. All of this means that today inflationary money creation and business cycles are not mainly generated in the traditional or retail banking system as was the case during the eras of most Austrian economists. Analyses of fractional reserve ratios, lending criteria, and interest rates for depository institutions are becoming increasingly quaint irrelevancies in the modern economic system, where far more money is created outside the traditional retail banking system than inside it. The layers and degrees to which maturity mismatching and fractional reserve banking can exist in the shadow financial system is not easy to survey. Now, if you thought fractional reserve banking was complicated for bank reserves, it is nothing compared to the complexity of performing the equivalent of fractional reserve banking for all financial assets and instruments held by the shadow financial system. Stocks, bonds, commodities, and all different kinds of debt are now part of maturity mismatched lending, which effectively means the claims for ownership of these assets dwarf the assets. The 2008 financial crisis was merely the collapse of this fractional reserve shadow banking system, sparked by an acute crisis in housing and mortgage markets. By bailing out most financial institutions directly, and by letting them borrow at lower rates, central banks played the role of lenders of last resort, allowing these banks to profit from mismatched maturity lending in the financial markets and to continue doing it,